Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Today on our economy show, we have a lot of different components to cover. The first part we're going to go through is looking at what happens after an epidemic, what happens after the pandemic, and what in terms of unrest and some of these issues that we continue to talk about with inflation going higher, grain prices going up, and just what is that pain level going to look like as we start to try to get into back to some growth and some normalcy around the world. Then we're going to follow that up with what's happening with rates and yield. We had the 10-year auction today. It was a little bit bearish, but the market was expecting that. So even though it wasn't as strong as I think some would have liked, the reaction is, I think, fairly muted at this point in time. And then what does that mean going forward? Then we're going to look more at what's happening with wages, jobs, as we had new jobs data coming out, and then what is the underlying impact that we should see as we go abroad and look at some of the pressure that remains at the inflationary level. Then we're going to look at Europe and emerging markets and roll in a bit more on grains in terms of where that pressure continues to reside in the market. And then we're going to wrap up with China and Asia, looking at some of those Asian indicators that we've looked at, and then give you that kind of roundup of what had happened at the Chinese Communist Congress, what did they say, and then what is the trajectory of China over the next 5 years. So just getting back into this, and then obviously we'd like to remind you, please, like, share, subscribe. Your support is always appreciated. So looking at this epidemics and unrest, so I'm going to be writing an article that will be in front of a paywall on Friday, talking about some of the issues that we continue to see. I've talked about Iran and how a lot of these things are happening from a point of weakness, and just because they're trying to stay relevant in the market. And when you look at what normally happens with countries with more frequent and severe epidemics also experience greater unrest on average. Not crazy jump to conclusion based on that headline, but let's use some of those econometric skills that some of these that we got from the World Bank. And when you start looking at some of the issues, you have to consider that when you're in the thick of it, it's really hard to riot, to do anything, because everybody's in pain, everybody's struggling, everyone's just trying to survive. But as you start to come out of this downturn, and now you're starting to get frustrated because it's not happening as fast as I wanted, I'm not getting the money I need, the issues start to become greater over time. And when you look at just how we continue to see some of these issues coming through, we're going to get this acceleration of just unrest in general. We've already started to see it in Iran and parts of the Middle East. We've already started to see it in obviously in Hong Kong and in other parts of China, but also more importantly in West Africa. When you look at Nigeria, some of these other areas where you've already had food riots, you've already had some of these problems starting to creep up. And unfortunately, it's only going to get worse, especially as we start to come out of this. And I don't see grain prices getting much better over the near term, and inflation continues to creep higher, especially with the U.S. rates pushing up, which is just going to make it more expensive for international markets and emerging markets to be able to borrow effectively to stimulate their economy. So let's put that into perspective, because if you're young and you are hungry and you want to work, the problem is, and this is just looking at the G7 because it's worse in the other countries, especially emerging markets, workers aged 15 to 24 have seen their share of the total pool of those employed shrink in each of the last two recessions. It dropped particularly fast during the COVID-19 pandemic. So now you have young males, and this doesn't get much better when you go to 25 to 34, because that is a big pool of individuals that are looking to work, especially depending on what they're looking to do, whether it's an internship at the lower end, and then your first job out of school at the top end. And then when you start coming into kind of those formative years, a lot of people are going to want to work. And we, even after that drop in 2008, we never got back to those numbers. And now with this next step down, you're seeing the pressure and some of this anger starting to butt up in Iraq, in Iran, some places that have a very young workforce. And the same thing is happening in other parts of Asia. this is going to be something to watch. And India is no surprise to that as well. When you look at some of the issues and some of the protests that some of the rural farmers have started to enact in against some of the issues going forward. So, but when you think of some of the pressure coming in on pandemics and issues, well, it's going to matter on who has nuclear weapons. So this was a great chart The Economist put together, looking at the number of parties that have these nuclear assets. So when we look at who is there, there's about 9 people who have 9 countries that claim to have nuclear weapons. Obviously, there's Iran who's pursuing them. So that's where we get to that 10. But when you look at the in possession, the ones that we want to look at the most is really the U.S., China, and then when you look at India and Pakistan in terms of where some of the issues that could come around, it is unlikely any of them, at least in the near term, would use anything, but it's worth to consider what is going to happen and what are some of the means of averting any issues and trying to make sure that there's a certain amount of balance that's maintained in the market. Now, when you look at what is the U.S. opting to do, so I thought this was a great chart from the geopolitical futures that came out today. When you look at the U.S. operated bases, where we're operating, the foreign bases hosting U.S. forces, which just means that we are guests at their base, and then we pay a certain percentage to be there. And then obviously the U.S. operates their own bases in some of these key locations. But there's also a move to build new facilities. And as we said last week, we're building about $27 billion, or the goal is to build $27 billion worth of forward missile defenses, and not, I shouldn't say defenses because that is defensive, of more forward smart missiles to defend against an attack on our aircraft carriers as China builds more and more aircraft carrier killers in deterrence, pushing us further away from the coast and essentially stretching the amount of effectiveness that the wing side of the aircraft carrier is able to achieve, because the whole goal is that has to be closer to the coast in order to be effective. But if China effectively pushes them further away, then you have a jet fuel problem in getting to your target. So the idea would be some of these missiles would take out some of those defenses and then allow the aircraft carrier to get closer to the coast. So this is something to consider when you're looking at that tit for tat on how are we going to look and how are we going to project strength while not being antagonizing, because how would China feel if they started building stuff in Cuba and Mexico? So you have to kind of weigh both sides of the argument and try to put this into context. And so when you look at what is happening in general, there's just where things sit right now. So the rising scrutiny abroad of anyone involved. So right now, when we look at what are some of the mechanisms that are being utilized, the China's trying to build out its own protection. So when you think about what is being done, Wang has talked about being tough on the U.S., making sure that they respect the differences that we have. And then Xi had a big call with a talk with the military, essentially saying that they have to be vigilant, that we're living in uncertain times, and essentially talking about the U.S. without talking about the U.S., about maintaining a certain amount of vigilance. But that's also India in general. So again, these are some of those pushbacks that we have to look at. And when we consider the issues on food, where they're trying to build out their food capacity, and that's why we keep talking about food as a big driving force of what is going to drive China to push forward. And then I've obviously talking about Wang, called for greater cooperation with the U.S. while simultaneously serving up fierce denunciations of American interference. The United States frequently interferes in the internal affairs of other countries under the banner of so-called democracy and human rights. The so-called genocide in Xinjiang is absurd. It is a rumor with ulterior motives. Again, these are things that what is going to be said prior to the meeting in Alaska is going to be very important. But it's also worth considering just kind of where we sit on the recovery side, because China's had a little bit of a bounce, but it started to slow down a bit. And here you can see on a global level, we still remain fairly stuck at this 80% as advanced economies are starting to roll back down. And that's really being driven by a little bit of a pause in the US and more of a slowdown in the European theater, which is going to weigh on those emerging markets, which have been fairly robust. And now Chile is rumors of another copper strike that would just create more pricing pressure, which again would pressure some of the purchases from advanced economies and again pull down some of the emerging markets that have recovered. But we're still not at the lows that we saw in March and April. So this comes down to as things start to get a little bit more normal, but they're not going as fast as people want, and people are still struggling, and you start to get this class warfare. That's where you start to see some of these uprisings and some of these pressures, which is why when we look at Chile starting to roll over, and India is the one that we talk about the most, where it's sitting, fairly comfortable at this 90%. But now we're starting to see some of the pressure come into that market as well. Not to say it's going to roll back over, but it's going to be difficult to kind of break that level and get back to that 100 as China and some of these other regions within Asia see kind of this flattening out of activity in general. And that's when we start to turn to what's happening in the U.S. And when we look at the U.S. in general and what's happening here, you can see that that we have essentially stabilized and started to, it's not really turned down, because February finished really strong, and now March is starting a little bit slower. And that's where you have to weigh, what is it, just because we had some of the weather impacts that were residual, and now we're going to get a little bit more of a snapback. It's going to be important to see how does March close to see where do we sit up. But right now, I'm comfortable in saying that going flat from here would be a small win, and then to see where things go. And as people digest the stimulus, they start to get their deliveries. But in general, on the European side, that continues to come under pressure, with Spain starting to roll back over. But more importantly, Germany and France are starting to come back under that pressure. And then when we look at, what does pressure mean? Because we talk about food, we talk about all of these different pieces, and this is something that Bloomberg Economics put together that I think is an important view of what is the central bank going to do? Because central banks have to look at inflation, and if the U.S. yield is moving up, if we have dollar strengthening, if we have our 10-year coming off at the high end or above what was projected for yield, that's going to make their fiscal stimulus more expensive. So if their fiscal stimulus is more expensive, then they're going to have to do something to kind of temper down inflation, because you're going to start to get these fears. So as inflation starts to ebb up and start to increase, if you look at the latest inflation overall, that's why you're going to have to start to see, or the expectation is that you're going to start to see some of these central banks increase rates to protect against inflation, protect against and take back some of this monetary easing to try to soften the blow and allow fiscal stimulus to go through and manage that portfolio a little bit better. And that's when you start to look at, what is some of the political uncertainties that we're talking about? Where is that happening? So when we look at just in the U.S., what are some of the issues? So the concerns in the U.S. is really political uncertainty with Biden. What is Biden going to do? We're still waiting to hear from different components of China policy, Middle East policy, but also this inflation. Now, we had CPI. I'll discount that, and we'll talk about that in a minute. But when you start looking at just inflation in general, gasoline prices, food prices, and just cost of living continues to go up, that's going to weigh on where those are, and that feeds into those rising rates. And again, these are those concerns that are at the top of everyone's mind. So if this is happening in the U.S., think about the emerging market space and how that's going to weigh on some of these individuals that are just above or at or below the poverty line, and they're concerned about their next meal. Those are individuals that that have nothing to lose, or feel as though they have nothing to lose, and will try to better their situation. And it's going to be mixed, because PMIs are going to measure how strong is the market going, how's manufacturing doing, where is general economic growth coming from, and it's fairly mixed. But you can see it remains at the lower end of the spectrum. And the reason why I love this chart is because it shows just how slow everything has been since 2019. And that's what I've been trying to stress is the pressure that's been in the international market, especially on the emerging market side, since 2019, and has continued to be a deterrent to economic growth. So you look at China, that is just kind of hanging out at this 50%, 50 number. You see the pressure that's been in South Korea, some pivots in some areas, but again, these are places that have to worry about stability. And that's why India is the one that we like the most in terms of kind of where some of this goes and why they're that little bit of a bright spot when you're talking about demand in general. But other Southeast Asian nations like Thailand, Malaysia continue to see a little bit of a slowdown. South Korea, something similar as pressure continues to mount. But then Latin America is going to be one to watch, especially that Brazil has now seen that growth and has had a pretty hard pivot at this point, which is going to make those numbers a bit worse, especially against comps. So that's when we start looking at global manufacturing pricing survey and that PPI number. That's where we continue to see those prices are only going up, and that's going to essentially export inflation. And we're just at the tip of the spear on how bad inflation is going to get as we continue to import. And this speaking about the U.S. at this point, and how imports are going to continue to drive up as our cost of imports rise. And this is just going to put continuous pressure on where we sit today. But as we look at where things are and we look at the margin debt and the pressure in the market in general, so the U.S. margin debt levels are breaking records. But when we look at 2007, because I remember this vividly as I was working in money markets at the time, BNP threw up gates on money market funds, and we've already started to see that to protect that short end of the curve. And if you just look at where we sit on that margin debt as essentially the S&P index continues to push to those highs, even on a year-on-year level, we're going to continue to see this pressure. And this is where rates are going to matter more and more, because as rates start to push up and yields start to go up and that inflation pressure drives higher, this is going to weigh on just, what is that? How much does it cost to borrow on margin? When is retail going to see their margin increases starting to pressure them in general and force them to sell, because that margin call is going to be that pressure? And that will start to incentivize. But we're already starting to see something similar to what we saw in 2017, especially on the front end of the curve in that overnight and 1 week rate level. But when we talk about the stimulus that Biden is putting out, you can see that right now the U.S. is going to be a big driver for that global growth, because there's that bleed down, which we'll talk about in the next few segments, looking at what Biden is delivering and what this stimulus will do for others, because we're going to get this money and we're going to spend it. And if, when you look at what does the U.S. spend stuff on, we buy things, and that is going to require more imports and pulling things into the market as China, and obviously coming off of a very easy base in 2020, the question is going to be the rest of the world, because I still think that there is a bit too much exuberance in terms of where GDP growth is going to be. It'll be growth. I'm not saying it won't be. It's just what level of growth continues to kind of move back and forth. And that's when we kind of round out, the pressure in general, because when we look at who's out of work, where do we have the highest jobless rates? The Philippines, Indonesia, again, speaking to why we think that there's going to be a problem. And these are places that have some stability. I'm not saying that they're going to turn around and riot, but as pressure mounts, they're going to be more likely to try to change their situation on a more violent course, because they feel disenfranchised and they're going to want to do more. Hong Kong is going to be that example as China tries to change the way their election process goes to make sure that there are people who are more friendly to the Chinese Communist Party. But these are things to consider. And the reason why is because the ASEAN 10-year yields are back in sync with the U.S. And as the 10-year went off at the high above the high end of the yield, that's going to start to put some pressure in terms of where things are. As you look at Indonesia, Malaysia, Singapore, this is obviously going to increase their cost of borrowing. But when you look at the GDP impact of fiscal stimulus, you can see, when you look at the forward-looking consumer, this is where we're going to see the U.S. putting money into people's pockets and then that feeding through the system. And that will be supportive going forward over the next few quarters. And when we look at the OECD raises its forecast, and it's really off of the view of this stimulus being pushed into the market. And that's where we're getting this rewrite of this data higher. But when you look at how we closed out February, how we're beginning March, you can say that people are just pausing because they're waiting for delivery of money and then they'll get back to action. But the inflation side, so consider where we sit right now. So, and I'll go through this again in a moment, but when you got a stimulus check in April of last year, prices were through a floor. Now you're getting a stimulus check with prices on the upswing and well above year-over-year levels. So the money's going to not go as far. And I'm not saying that other individuals aren't calculating that or factoring that in, but I think there is an overestimation of the damage that's been done based on wage compression and some of the other issues that's going to limit the amount of money that's going to be available to be pushed into the market. But with that being said, here's where you get this adjustment on with the 1.9 trillion in stimulus. We're going to go right back above what the projection was pre-COVID, and then you're going to start to taper off. The question is going to be how big is that pop based on what is the consumer going to do and what is the manufacturing capacity as inflation continues to work its way through the system. Then when we turn to contributions to GDP, the view is that obviously we're going to get this stimulus check, which is the stimulus is in the blue, and that you're going to continue to see that work through the system over the last few quarters. But when you think of stimulus checks and we look to April of 2020, it was a flash in the pan. It was there and then it wasn't. And it reverberated. There was a little bit that went through it. And when you look at what are some of the benefits, the enhanced unemployment benefits are going to be there consistently, and that's going to be that long-term move. It's just the stimulus checks is not going to be something that's going to be repetitive. So now this is looking at the contributions in terms of it's working its way through the system, velocity of money, money's going to move through the system. So if you put it in, and then when you look at inflation, that's going to keep it in the system. I just think that we have to adjust or understand that the impacts could be a lot less, just given the fact of inflation impeding the overall throughput of this capacity. And then that's when we start to turn to what is happening with commercial paper and who is the buyer of just assets in general. So when we look at financial commercial paper outstanding, obviously we're moving back to the highs, but the foreign ownership of our paper is now at the highest level it's ever been. So as we see rates going up and we cross over on the yield capacity of the 10-year versus the S&P 500, you're going to get people that are going to turn away from equities and into the bond market. And this is going to put some pressure. But what happens if the international consumer has to raise capital, has to raise dollars, has to do something to mitigate against inflation fears, mitigate against some of these other issues? And this is going to force them to raise dollars. And what's more liquid than commercial paper? So then you're going to turn around and you're going to get this pressure to the downside, which again will push up yields, push down prices, and it's going to impact some of the overall recovery factors within this GDP move as we go through 2021. So now that we talked about that, in the next segment, we want to go through in more detail, what does it mean on inflation and the rising yields that we continue to kind of forecast as that pressure mounts, not just in the US, but also on a global level.